becoming a member. Last, you'll definitely want to dig deeper into tonight's topic, and I recommend you purchase your own copy of Nick's book. The best way to do that, easiest way to do that certainly, is to use the link in the chat below to buy through Third Place Books, our terrific local independent bookseller. And with that, based in Washington, you know, that Washington, Nick Timiraos is Chief Economics Correspondent for the Wall Street Journal. He's responsible for covering the Federal Reserve and other major developments in U.S. economic policy, but Nick's been with the paper since 2006. So prior to his current position, he covered the Treasury Department, fiscal policy, and broader economic and labor market issues. Before that, he wrote about U.S. housing and mortgage markets as a reporter based in New York City. His coverage included the government's response to the foreclosure crisis and the takeover of finance companies Fannie Mae and Freddie Mac. In 2008, Nick contributed to the Journal's presidential election coverage and traveled with the campaign of then Senator Barack Obama. David Wessel, meanwhile, is director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution and has 30 years of experience as a reporter, editor, and columnist, also at the Wall Street Journal, as it happens. He's a New York Times bestselling author and shares 2 Pulitzer Prizes, one for Boston Globe stories back in 1983 on the persistence of racism there, and the other for stories in the Wall Street Journal in 2002 on corporate wrongdoing. Nick Timiraos' book, Dollar Triage, is the subject of their discussion tonight. So please join me in welcoming David Wessel and Nick Timiraos.
Thanks, Ware. It's good to be with you tonight, and particularly good to be with Nick, of whom I'm very proud to work with as a colleague at the Wall Street Journal, and to see him doing such good coverage of such important issues as how the US government, the Fed in particular, responded to the devastating pandemic, something that we never saw coming and really are lucky to have survived. Nick, I think it would be useful if you started by talking about what role did the Fed play? In March 2020, the pandemic hits the United States. The government essentially puts the US economy into a medically induced coma. And part of the government's response, in fact, you might say the first response, came from the Federal Reserve. So maybe you can just describe simply, for people who haven't read all of your stories and haven't yet read your excellent book, what did the Fed do and why was it so important?
Sure, great question and wonderful to be with you, David. And thank you to Town Hall and Ware for having me. It's a pleasure to be here. So really the title for this book comes from those weeks in March of 2020 when the Federal Reserve of all institutions was sort of the frontline responder to an emergency that was unfolding because of the pandemic. And they began in early March actually cutting interest rates at an unscheduled meeting. We in the press call that an emergency meeting because they have regularly scheduled meetings every 6 weeks. And there were some central bankers in Europe who teased Fed officials that day. It was March 3rd, so we're almost exactly, we are 2 years, sorry, from kind of the beginning of that crisis. And the central bankers said, gee, you know, you people in Washington, if aliens invaded, your first move would be to have an emergency Fed interest rate cut. And so it was an unusual time because there was so much uncertainty about what was going to happen in the economy and what was going to happen in the financial system. And so the Fed ended up being kind of the first mover. And if you think about where we were at that point, you know, we had a president who had been very belligerent towards the Fed. President Trump had been demanding the Fed cut interest rates for a year, for 2 years, as he was prosecuting his trade war. And so now you actually had the emergency that came. You know, Trump had wanted kind of emergency monetary policy, and now we were getting it. Trump had wanted lower interest rates in the worst way, and now we were getting lower interest rates in the worst way. The rate cut really didn't do very much, and what began to happen the week of March 9th was just a run for cash, a dash for dollars globally. Companies began to draw on credit lines. Huge amounts of money were being borrowed, and you really saw panic begin to set in across U.S. financial markets and global financial markets. So the Fed employed what I refer to here as triage. They began to make unlimited amounts of money available to Wall Street banks in the hope that banks would lend freely, and the money was not flowing through the pipes. So then the Fed went one step further and they said, okay, we'll buy Treasury debt directly. This is the backbone of the financial system, the supposedly risk-free, government asset, and that wasn't working. So Jay Powell, the chairman of the Fed, begins to say, all right, we're going to have to move a lot faster here. And the Fed really began to take increasingly aggressive and unprecedented steps to make sure that companies and households weren't going to see, credit completely dry up.
So, as you know, Nick, I wrote a book about the once in a lifetime crisis about the Fed in 2008 and 2009. And at the time, the chair of the Fed was Ben Bernanke, a very accomplished economist who had spent his whole life studying the mistakes that the Fed made during the Great Depression and was determined not to repeat them. Jay Powell is a very different fella. He's not an economist. He's a lawyer. He worked in finance. He worked at the Treasury. But as then, the Fed chair is the one who really is both the quarterback and the coach of the team. So tell us a little bit about Jay Powell and how he got this job and how he responded when he was presented with a challenge that really he wasn't prepared for, and neither was anybody else.
Yeah, that's a great question. So he is sort of a creature of Washington. He was born here. He lives right down the street from the house he grew up in Chevy Chase, which is a suburb of Washington, D.C. A son of a lawyer. He followed in his dad's footsteps to Georgetown Prep, which is the same high school that Trump's Supreme Court nominees Neil Gorsuch and Brett Kavanaugh attended. He was classmates with the son of Robert Kennedy. So RFK Jr. was in his class. So he knows Washington. He grows up in this environment in Washington. The sorts of rarefied settings he finds himself in are not something he's completely unaccustomed to. And as you mentioned, he studies law. He works at white shoe law firms for a couple of years, doesn't love it. He goes into banking. And in the 1980s, he actually works at the firm where the future Treasury Secretary, Nick Brady, is one of the co-founders. And Brady brings Powell down to Washington when he becomes Treasury Secretary under President Bush, George Bush Sr. So Powell sort of cuts his teeth. He's young, he's 38, 39. And he has a, kind of a crash course in how Washington works. He goes back to Wall Street, works in private equity at the Carlyle Group, a Washington-based private equity company. And then he isn't terribly successful. He makes a lot of money there, but it's not as if he's, one of these swashbuckling corporate raiders. And so he actually leaves in 2005, and he's a little bit in the wilderness for a while. He doesn't have he leaves Carlyle, but he doesn't really have a new thing. And after a few years of that, he decides, what, I want to go into public service. His dad, who had 6 children, wasn't able to do that, wasn't able to go work in the Labor Department when President Nixon had offered a job. And so he says, I've done well financially, I can do this. But how do you don't sign up to go work in the government, certainly not when you're a Republican and there's a Democratic president, which we had with Barack Obama at the time. So he actually finds himself as the lead kind of expert during the debt ceiling crisis of 2011. This was when Republicans, the Tea Party Republicans, were threatening not to pay the bills that the Treasury had incurred. And he's sort of the person that Treasury Secretary Tim Geithner at the time turns to as the voice of reason. Powell's the guy who's going out there saying, you really can't do this. You want to default, you want to threaten to default to force spending cuts, but that's just not going to work. And when this standoff is resolved, Tim Geithner says to Powell, hey, would you like to take an appointment in the government? At the same time, the Obama administration is having trouble getting their nominees confirmed to the Fed board. And so they decide, well, we can pair one of our Democratic nominees with Powell. This Powell guy has made a lot of sense. And so that's how Powell ends up at the Fed, sort of a happy accident for him. Fast forward 5 years later now, Donald Trump is president. Powell is the lone Republican on the Fed board, and he has really supported the policies of Ben Bernanke and Janet Yellen, who preferred easier money policies than what the Republicans had wanted. And Trump's, he's the king of debt, right? He's an easy money guy. He doesn't want to have high interest rates, even though that's what conservative Republicans have said we need to have. So you get into this interesting place where Trump decides he's probably not going to stick with Janet Yellen because he wants his own person in the job, but he likes her policies. And so Jay Powell ends up again, sort of happy accident, I guess, for him, right place, right time. And Trump makes him Fed chair. I would also say it sort of helps that he looks the part, right? He has this sort of patrician silver hair bearing. And as I write in the book, the looks matter to Trump. So there's a meeting he has with an advisor who doesn't advise him on anything related to what we're talking about here, financial policy. But this is during the appointment process when he's deciding who he's going to put as the new chairman of the Fed. And he asks this person, is Janet Yellen tall enough to be Fed chair? Janet Yellen is about 5 feet tall, and she's already been the Fed chair for 4 years. But that kind of gives you an idea that, the looks did matter to him. And Powell looked the part. He had the right views. He was also a Republican. And so that's how Jay Powell becomes the chair of the Fed.
And do you think this was his ambition to be Fed chair, or do you think it sort of fell into his lap?
Yeah, far from it. Not at all his ambition. As you know, I mean, and for people who don't follow the Fed every day, there's sort of a priesthood of central banking. There are these people in, monetary policy, whether it's in academia or finance, and everybody knows who they are. Ben Bernanke was certainly one of them. Janet Yellen was certainly one of them. Alan Greenspan had spent a lot of time in Washington economic policy circles. Powell really isn't that. So no, this was not his great ambition in life. I think he would be the first person to admit that. But when he gets to the Fed, and the Fed is it can kind of be a boring and lonely place if you're one of the 7 governors who isn't the chair. You don't have your own staff. It's not necessarily it's not a sexy job by any stretch of the imagination. But Powell gets in there and he just sort of learns the nuts and bolts of the place. And so the sorts of things the Fed does when they're not deciding whether to move interest rates up or down, managing payment processing, managing the affairs of the other 12 reserve banks. There's 12 of these regional Fed banks. And so Powell just kind of throws himself into all of this. And he also, even though he doesn't have a PhD in economics, he sort of gets his PhD just by being in this, temple of economic prestige, technocratic prestige.
Yeah, I mean, the Federal Reserve Board, as you know, has 400 PhD economists. And from what I heard, the staff was impressed that unlike some of the other non-economists, he seemed to want to really understand what they were talking about, as opposed to just getting enough talking points to get to the end of a speech. As you've written about Nick, he also was really good at dealing with Congress. So you can describe, how did he do that and why did that prove to be so important?
Right. So he becomes chair in early 2018. And the context, I think, for that point in time is important because the Fed has just come through a decade of really harrowing, as you write about in your book on the Fed. They go through the financial crisis, but then the aftermath of the financial crisis is unpleasant. The economy is just not growing through the early part of last decade. So the Fed has to resort to lean even more on these unconventional monetary policies where you're not raising or cutting interest rates, you're buying larger quantities of government securities to try to get long-term interest rates down instead of short-term interest rates. And Powell sees that, politically, this has been a really searing time for the Fed. And so he uses his own kind of force of personality. And he's not, I wouldn't say he's some big extrovert, but he's a normal person, as normal as you can get into one of these jobs. And he uses the relationships he makes with people, including Republicans and Democrats on Capitol Hill, to help them understand that, he's a normal guy. He's listening to them. He's a very good listener. And he uses those skills as a listener, as someone who's able to analyze lots of information, For example, Republicans want to hear more about whether you're going to follow prescribed monetary policy rules. That was really important to them 4 or 5 years ago. And so he says, he offers to them, yes, we're going to do that. And you have some Democratic lawmakers who want to hear the Fed talking more about the distributional impacts of their policies. How do your policies help or hurt those lower income groups or marginalized groups? And so he's listening to, he's, I would say, a retail politician. He's not a partisan guy. He's, remember, he's the guy who told Republicans to knock it off with their debt limit brinksmanship, but he's very politically savvy. And that serves him well because, as I write in the book, almost from the very beginning, he has a very short honeymoon with Donald Trump. The Fed is raising interest rates in 2018 because the economy is doing pretty well. And the Fed's trying to make sure that there isn't going to be an inflation problem. And so they're raising interest rates, and Donald Trump probably knows better than anybody who's ever been president what the impact is of a 1/4 percentage point increase in interest rates on debt, because debt, he's the king of debt. That's how he financed his real estate businesses. And he doesn't like it. And he makes clear he thinks the Fed is going crazy. The Fed's out of its mind. There's a big market hiccup at the end of 2018, and he threatens to fire Jay Powell. He fumes to his advisors that this is the worst decision of his presidency. He's going to make me a Hoover, referring to President Herbert Hoover, of course. And so, it's at that point where Republicans who went along with a lot of the more unusual things that Donald Trump did could have said, this Powell guy is completely screwing up and we're right with you there, President Trump. And they don't do that. And I think that's a sign that it was sort of weird to all of us who cover this, that in 2019, when the president is on the warpath against Powell and Republicans are accommodating a lot of the behavior of the president, the Fed was sort of the one thing where they drew the line and said, don't mess with that. Don't mess with this guy. He's a serious straight shooter. And everybody in Washington, it seemed, kind of closes ranks around Powell.
Yeah. So at times of crisis, the relationship between the Fed chair and the Treasury secretary is always important. Alan Greenspan and Larry Summers during the Asian financial crisis, Ben Bernanke and Hank Paulson during the global financial crisis of 2008-9. What was the relationship between Treasury Secretary Steve Mnuchin, Trump's Treasury Secretary, and Jay Powell like during the opening innings of the pandemic?
That's a great question. When I'm talking about how Powell got the job, it's important to note that Mnuchin had clicked with Powell early on and had strongly recommended Powell to Trump as the person he thought should become the Fed chair. And so when Trump gets upset with Powell, he's also upset with Mnuchin. But despite all of that, Powell and Mnuchin have a very good relationship. I think the challenge, to the extent there is one in that relationship, is just that the Treasury Department under Stephen Mnuchin is not terribly well staffed. And so you have this reliance on the Fed to do things that sometimes maybe the Treasury would have been the lead on. And in this case, the Treasury is saying, well, when the crisis first hits in March 2020, you heard, especially from some of the president's senior advisors like Larry Kudlow, this isn't a job for us in the White House. This isn't a job where we need to spend money. You're already seeing, governments in Asia where the virus has been, present for a few months, sending money directly to citizens. And the White House is basically saying, this isn't a job for us. This is something the Fed can take care of. But Mnuchin and Powell have a very good working relationship, far better than you would expect given the degree of rancor that came Powell's way from Trump.
So I think the headline on your book and on most economic accounts is that economic policy, both what the Congress did with all the fiscal stimulus and the CARES Act and the American Rescue Plan, and the aggressiveness of the Fed cutting interest rates, buying trillions of dollars of bonds, lending to all sorts of entities that the Fed had not lent to in the past, helped make what was a very sharp recession a short one, and made for a recovery that is substantially stronger than most forecasters anticipated. I mean, 2 years later, we have unemployment at 4%, and we're worried about the economy growing too fast and generating inflation, not about the jobless recovery that we suffered after the Great Recession. But nobody's perfect. And I know you've identified a couple of things that, with the benefit of hindsight, and we get to do that as journalists and historians, that the Fed got wrong. So talk about what you think the Fed, with the benefit of hindsight, did wrong.
Sure. And, to your point, the whole crisis response, Powell talked about this as we were building a bridge, right? We were trying to get people across this chasm of the pandemic, and we didn't know how long the bridge needed to be. And, you'd rather overdo it than underdo it, right? Because if you don't make the bridge long enough, then people fall and they don't get across. So with that, with that kind of metaphor in mind, when we get to the other side of this, and we're not completely sure that we're there, even I think when we're there, we don't know we're going to have vaccines, et cetera, et cetera. But the Fed, before the pandemic hit, had been worried about a problem that sounds very funny right now, which is that inflation was too low. But the concern was when interest rates are pinned near zero, the Fed can't do very much to stimulate the economy with its conventional arsenal. And there's a risk that the public will expect lower and lower inflation. And the Fed pays a huge amount of attention to what we call inflation expectations, which is essentially consumers and businesses' expectations of inflation in the future. Economists think this is really important in determining actual inflation. So there was a concern that, gee, we're stuck in this trap of lower interest rates and lower inflation, and we're never going to get out of it. So before the pandemic hits, Powell is thinking and leading his colleagues towards making what seems like a minor change, but is going to end up proving to be more important. And that is that the Fed, which defines their mandate of stable prices and full employment, they define the price stability mandate with a 2% inflation target. And they decide that going forward, we're going to take into account past misses of inflation. We're going to try to make it up a little bit. And so we're going to actually seek periods of above 2% inflation. We want a little bit more inflation. So they're getting to making this change. The pandemic hits, they put that on the shelf. They take it back off the shelf in August of 2020, 6 months into the crisis. And they say, all right, there's a lot of concern that we're going to be right where we were after the global financial crisis of 2008. So we're going to make this change to try to provide just a little bit more oomph to our policy. And they operationalize it by saying, we will keep interest rates at zero until we meet that inflation goal of getting inflation a little bit above 2%, and until the economy hits maximum employment, which they never really define, but it's assumed to be around 4%. What ends up happening over the course of last year is, as the economy really begins to heat up, you begin to regret having made that commitment, because maybe you wanted to raise interest rates before you get to maximum employment. And you could raise interest rates just a little bit and you wouldn't be strangling the economy. But they had made that commitment because they were so concerned about demonstrating their new framework would be credible. And you wanted that to be credible because if you think you're going to be stuck in zero interest rates in the future, you want people to think that your tools are actually going to do something. So that's a long way of starting to answer your question. What mistakes did they make last year? I think there were 4. That's the first one. Then you have the fiscal stimulus that the Biden administration passes, which was almost exactly 1 year ago, $2 trillion on top of $4 trillion that Congress had approved in 2020. And so now the Fed has encouraged more government spending, maybe not $2 trillion worth, but they've said, we need to make sure we get people across this bridge. And there's a reluctance now. We've made such a big deal about how we really want to get to full employment. We can't turn around and say, well, Congress, hey, too much, you overdid it, right? So that's kind of strike 2. Then you get into last spring, where you see inflation begin to really pick up. And part of that's because so much of our economy is in producing and purchasing services. But during the pandemic, you couldn't go to restaurants, you couldn't travel. So we were spending more on, kitchen appliances and furniture and cars, and the supply chains just couldn't handle all of that. So initially the Fed says, well, we think this is transitory. We think this inflation we're seeing right now, it's a one-off. And the central banking textbooks say you're not supposed to react to one-off increases in the price level. And so they sit on their hands. They're demonstrating their new framework. They're not going to push back against the stimulus, and they're describing kind of what's happening in the economy as a temporary thing. Finally, the fourth challenge, maybe mistake they make, is they're very reluctant to upset markets. There's a lot of debt in the market. The Fed had this experience under Bernanke in 2013, where they signaled maybe they would remove some of their stimulus. They were purchasing assets. And there was the taper tantrum where long-term interest rates went up a ton, and they didn't want that to happen. And so they were very careful last year about not making really the same mistakes that they thought they had made after the financial crisis of 2008. And I think what we're seeing now is, when you fight the last war, you don't make the same mistakes you made last time, you make new mistakes. And that's probably where we are today.
Right. I just want to encourage people to send your questions in, and I'll pick them up as we go along. So basically, they start from having not enough inflation. They end up saying we want to have a little more inflation. They get a lot more inflation. And so it looks like they kind of overdid it. And now they're, as in the lingo of the people we talk to, Nick and I, behind the curve. So do you think they screwed up? Do you think they screwed up by not beginning to raise interest rates sooner?
I think it'll be a lot easier to tell in a year or 5, or 20, right? But today, Powell was on Capitol Hill. He was testifying in front of Congress, and he said, look, in hindsight, if we had thought that the supply shocks were going to go on and on and on, we wouldn't have kept things where we did as long as we did. So that's about as blunt and candid as I think you'll ever hear a chairman of the Federal Reserve be about a policy mistake or policy error. But there was a lot we didn't know last year. When I was finishing up this book, we had vaccines, and it seemed like maybe the pandemic was something that would be in the rearview mirror, and then we get hit with Delta and then Omicron, and so we're still kind of being buffeted by this pandemic. So I think, yes, they may have overdone it. Powell was asked about this last September, are you overdoing it? And he said, look, the history books are full of examples of underdoing it, and I don't think we've done that this time. When he's been asked more recently, he said kind of what I said at the start, which is, well, history will judge how we handle this episode, down the road, and hopefully I'll be alive to see it. So I think we probably see that. I think what we've learned is that forecasting the economy is always difficult, and it's extremely difficult after you close down a $20 trillion economy for a few months and then open everything up. And you have other, countries around the world doing the same thing, but at different times.
So when you write a book, as you did, Nick, you get to go back and re-report things that you covered as they sped by. And so one of the viewers asked, what was the most unexpected thing that you found as you were going along?
Well, I don't know if it was unexpected, but I think the most, if you think about 2020 and the first half of 2020, what was the most controversial thing that the Fed did, or that any of the other, economic policy actors did? And it really was something the Fed did that I'm thinking about. It was they said that they would purchase corporate debt, and not just any corporate debt. Initially, they said they would come in, they had never done this before. They said they would backstop corporate debt markets. And the reason they did that was because the corporate debt market was closed. On Friday, March 20th, 2020, you just couldn't, if you were a Google or a Microsoft, you could issue in the corporate bond market, and it would have been very expensive. And every other company would have seen that and said, gee, if these blue chip companies have to pay that much to issue, we're toast. So the Fed came in and said, we'll buy corporate debt. and we'll do it. The Fed doesn't like to take, this is considered very risky lending for the Fed because you can lose, you're not buying a government-backed instrument like a mortgage bond that's backed by Fannie Mae or Freddie Mac or a government security. And so they wanted to have some money from the Treasury to backstop losses. You go forward, roll the tape for another 2 weeks, and now the companies that can borrow from the Fed have done pretty well. They are now able to access the market. The companies that are too risky, they're considered junk debt. It creates a cliff, and now that cliff is getting bigger and bigger. And so the Fed decides, and Powell really, Powell is the one who has to make this call. He says, all right, we're going to purchase a little bit of junk debt. We're going to do it through these vehicles called exchange traded funds. And so we're going to buy junk ETFs, which was very controversial on Wall Street. Making matters worse, they're relying on BlackRock, which is the company that produces all of the most of these ETFs. They're now relying on BlackRock to buy them. And again, I can't stress that at the time this was a very controversial thing. So what did I learn? I think, as I look back now, there's not a lot of controversy about this. The decisions to bail out Lehman Brothers and AIG in 2008, even though I think a lot of historians would say, well, we didn't bail out Lehman, but maybe we should have, and we did AIG, and we're probably glad we did. There's not a lot of people criticizing now what was seen as something very controversial then. And in fact, I think you could raise the question, if the Fed hadn't done that, if the Fed had basically said, you know what, some of these companies, they took on too much debt, and yeah, businesses don't plan for a zero revenue environment because of a pandemic, but maybe you will now, so take your medicine. You're talking about the inflation a few minutes ago. I think we'd be seeing even bigger problems in the capacity of the US economy to produce goods and services if the Fed hadn't taken that step. Now, it does raise serious questions for the future, creates a moral hazard, but I think, so I would answer the question. One of the surprises, I think, is that there hasn't, at the time, it seemed like there would be a lot of criticism of this. And you go forward 2 years and it feels like people barely talk about it anymore.
Yeah, it turns out that if you have a financial crisis that's driven by Wall Street and you bail out Wall Street, you get a lot of grief. It's a lot easier to bail out the economy and businesses from a pandemic.
Right.
When no company, no MBA is responsible, as far as we know, for the COVID-19 virus. Some people are interested in what's it like to cover the Fed, Nick. So as we both know, it's a good job. It's a great job. And one of the things that makes it great is that the modern central bank, not only the Fed, but others, realize that communicating with the public and the markets is an important part of their job, and the press is one of the channels. So people who care about the markets and interest rates sort of read every one of your stories and dissect the adverbs and the attribution. So how much of a burden is that when you write, and how much do you worry about people misconstruing or overinterpreting what you know?
Well, I listen to wise old hands like you who tell me not to worry about what people are going to say and just write what I know. But yeah, you're right. Central banking has changed a lot. I mean, when you were doing this, when you started doing this, the Fed wasn't putting out statements that said whether they had raised interest rates, right? So you'd have to figure out from kind of money market shops what the directive from Alan Greenspan had been to the federal, from the Federal Open Market Committee to change the money supply. There's now almost an overwhelming amount of information every day. If you cover this stuff, you're bombarded with different Fed Reserve Bank presidents giving speeches. Because of the CARES Act, Jay Powell has to testify an additional 4 times a year. So it feels like he's testifying every few weeks, and there's a press conference after every meeting. I would say I feel very fortunate because the Wall Street Journal cares a great deal about the Fed. I never have to justify a story to an editor about, well, why are we writing about the Fed? I mean, this is our franchise. We know that the modern central bank is important. They determine the level of overnight borrowing, and so it's a fun responsibility to have this job.
And someone asked, what made you decide to write a book? Is this always something you wanted to do, or what pushed you over the edge on this one?
Yeah, I've always wanted to write a book. I thought that Powell was an interesting character because here's somebody who he shows up in Washington in 2012. He's had this career, but he's a little bit of a mystery. You know, people don't know who he is. Even by the time he becomes Fed chair, he's not that well known. And you know, he's the guy that Donald Trump picked, and so fast forward to the pandemic, and now we've gone through, you know, the Fed has crossed a bunch of red lines that they really resisted. They didn't do some of this stuff in the financial crisis that you wrote about. And they did them here in a matter of days. You know, they just, every day it felt like they were adding new pages to the Bernanke 2008 playbook. And so I thought, all right, maybe there's a book here. And, you know, I think there was. I think that people are going to want to look back at this time of 2020 when a pandemic hit. You know, why wasn't there a financial crisis? What is it that people were doing, thinking, remember, they're not doing this. They're not spending time in conference rooms late at night drinking Diet Cokes the way they were in 2008. They're all doing this really from their homes, with the exception of Congress, where people took real public health risks to go pass that legislation in the last week of March 2020. You know, it maybe lacks some of the drama of you know, frenzied late night phone calls. They're doing everything via Zoom. But, you know, I think it was a historically important period. And it's important for people, especially now, as it seems like we're just running into the next crisis here. And so, you know, this is a chance to sort of sit back and say, all right, what actually happened here? How did we somehow manage to get through this period without a complete meltdown of the system?
So most of the people listening to us are in the other Washington State, which is a long way from where you and I are and a long way from Wall Street. So somebody asked, what is something that you think the audience really needs to know about the Federal Reserve and may not know?
Well, that's a great question. You know, where to begin? I think one of the dangers is in relying on an institution like the Fed to do too much, right? And so there's a risk in this crisis that we just went through, that people become complacent and they think, well, when something bad happens, you know, we'll put that with the Fed. We'll rely on the Fed. There's a lot of people who feel like the Fed has become too powerful, and the Fed is always kind of rushing to the aid of you know, whatever the crisis is of the moment. I think there's a lot of merit to those criticisms, but you also have to keep in mind that the people who have these jobs, they have to play the hand that they're dealt. And so, you know, there are trade-offs in any decision. One of the things I find interesting along these lines from 2020 is that a number of the lending operations that were created, which I spend a little bit of time talking about in this book, you know, they didn't have to go reside inside the Federal Reserve. They could have been inside the Treasury. So as an example, during the New Deal, Roosevelt creates the Reconstruction Finance Corporation, which is basically an industrial lender. And, you know, that way, the concern here would be that you would be having very political decisions in the hands of an institution that is supposed to be apolitical, right? Who gets credit and on what terms? That might be something you would want kind of elected officials or political appointees outside of the Fed to be deciding. The same thing was true with the agency, the government corporation that was created to clean up after the saving and loan bust in the 1980s, the Resolution Trust Corp. So these were not things that we put inside the Fed. Why did we do that in March of 2020? I think a big reason is that Democrats didn't trust the Trump administration, but they did trust Jay Powell and the Fed. They had seen him stand up of sorts to Trump. And so they said, you know what, we're afraid that, you know, businesses that run afoul of this administration might not get help if we put this in the Treasury. So let's just give it to Powell, and we can feel a little bit better about doing that. But that creates risks down the road, because What happens if someone says, well, the Fed can finance the border wall, or the Fed can finance a massive greening of the economy program. And if you ask the Fed to do more and more, it's going to mess up again and again. And then you get away from sort of the reason we had the whole thing to begin with, which was to maintain a sound currency.
Right. I just want to encourage people, if you have any questions, to put them in the chat or all the other instructions that Weir gave you. Yeah, it's pretty remarkable. After the global financial crisis, Congress thought the Fed had too much power and actually tied their hands a little bit. And then this crisis comes along, and as you point out, they do just the opposite. They pass legislation that says, okay, we're willing to lend hundreds of billions of dollars of money to businesses and some households, but we want that to go through the Fed. We don't trust the Treasury to do it. It's really a remarkable sea change. So Nick, we know that the Fed is going to raise interest rates on March 16th with extraordinary, I don't know, I was going to say candor, but it's just, I've never seen a Fed chair who actually went to Congress and said, yes, we're raising interest rates a 1/4 percentage point at the next meeting. It takes all the suspense out of that. We know they're going to have to keep raising interest rates throughout the course of the year, given how much inflation has risen. I wonder what you think the Ukraine crisis has done, other than just complicate the Fed's job and make all of us worry about the prospect of nuclear war.
Well, I think the bottom line is that, this war in Ukraine really couldn't come at a worse time for the economy or for the Fed. And that's because, again, as we were talking about earlier, when you have a huge amount of oil, in this case, come offline, that is a supply shock. It's going to send up prices. The textbooks say, don't respond to that. There will be an offsetting, hit to demand, and it's a one-time increase in the level of prices. It's not a year after year after year thing, which would be inflation. But when you've had a year of 7% or 5%, whichever measure you want to use, it's very high. It's the highest in 40 years. And when we've had 1 year of that, if consumers begin to demand higher pay, if they expect prices to be higher in the future, if businesses are able to pass along those costs, that can be the beginning of an inflationary cycle. And so this is a very unwelcome development for the Fed. And just, even before we get to Ukraine, you think of the questions that we're facing economic policymakers this year. There were a ton of them. We have 3 million fewer workers in the labor force. Are those people coming back? What happened to them? We have all of this increased spending on goods instead of services, and that's leading to very extreme price increases in goods. Is that composition going to normalize? What happens to supply chains? Do they unclog? What happens to all the money people have saved up during the pandemic? If there's no more fiscal stimulus, does that become a drag, or do the higher personal savings rates allow for a little bit more of a buffer there? And how much will higher interest rates cool down demand? So you just had a number of pretty big unknowns, and now you're throwing, you're pouring fuel on the fire. And it's, I think it's going to be very difficult. The other challenge here for the Fed is, as you know, Powell hit people over the head yesterday when he said, yes, interest rates will go up and it's going to be by this much, and now we're taking that piece of uncertainty out of the market. But there's a view in the market that the Fed, doesn't want to move too fast because they're worried about creating a bunch of volatility. And in the same way that in March 2020, Powell had to find that gear. He had to find a new gear to kick the Fed into, because he felt, he says at one point to his staff, it feels like we're swimming after a speedboat. I'm not suggesting the Fed is going to raise interest rates anywhere nearly as aggressively as they responded to the emergency of 2020. But if you do think we're heading into an emergency here, you may need to find a new gear. And so Powell's challenge, I think, is going to be trying to figure out, okay, we're not going to go a 1/4 point every quarter, which is what the Fed did in the last rate increase cycle last decade. but they're going to want to try to find a way to get interest rates back to a neutral level of 2% before too long, because it doesn't look like inflation is going to be coming down on its own the way Fed officials have been talking optimistically even 2 weeks ago before this whole disaster in Eastern Europe.
Right. It's a pretty delicate balance. The history is that it's really hard to bring down inflation without overdoing it and causing a recession. So the challenge is to do enough to slow the economy so we get supply and demand in better balance and bring down the inflation rate without doing too much and ending up with a recession. And you have to kind of do that constantly absorbing incoming information and not being sure about what lies ahead. It's pretty tough. Do you think that the Fed will continue to have? So the Fed's argument is, as long as people expect that we can control inflation, as long as inflation expectations remain, in their words, anchored, as long as when you ask people and look at markets and they say, okay, we're going to have high inflation this year, excuse me, but they expect to return to something like 2% in a couple of years, that they can manage this. But that requires a great deal of trust in the central bank. Central bankers call it credibility. How much risk do you think there is that what's happened with these clearly exposing the Fed for having an inaccurate forecast, clearly having more inflation than they anticipated, now having to rush to catch up? How much do you think their credibility is at risk now?
Yeah, there's a lot we don't know about, how, for all of the very smart people who work at the Fed on this, there's a lot we don't know about how inflation expectations are generated. And the predictions, the forecast last year were very wrong. So I don't know how much comfort you would necessarily take right now that, there's a lot of inertia in inflation, right? So I would say it's hard to have tremendous amount of confidence in the models when we've been through a shock like this. But the other point, you use the word credibility. One thing I was struck by in the last 2 days when Powell testified before Congress is, high inflation is politically very unpopular, right? That's obvious. And so I was thinking that maybe lawmakers would be a little bit more unhappy with Powell and beat him up a little bit, because it's easy to say, the Fed can be a convenient whipping boy. Well, this is all your fault. But as I was saying before, Republicans in general, not all of them, but a lot of them, they seem to really like the guy. And so they were more sympathetic to him. Oh, you have such a tough job. I don't envy what you're going to have to do if you have to raise rates and put us into a recession. And Democrats, I think, are a little bit vulnerable here because, they were encouraging a lot of spending last year. And when people like Larry Summers or Jason Furman were saying, maybe we should put one log on the fire at a time, maybe we shouldn't put all the logs on the fire, that was not the way that they went. And so it's harder for Democrats. So I find it interesting that here where we have 7% inflation, and you might expect people to be very unhappy with the Fed chair. He's just been nominated for a second term by President Biden. He hasn't been confirmed because there's a standoff over one of the other Fed nominees, but it looks like he's going to win a fairly bipartisan vote. That he, so much so that we in the press would barely talk about what his chances are of being confirmed because it's just taken that he's a shoo-in. So how crazy is that, right? That inflation is this high, and yet nobody's suggesting here, hey, let's dump Powell and find somebody who has a PhD and can really whip inflation.
Somebody asked, do you think the Fed will have the fortitude to actually decrease its balance sheet?
I thought you were going to ask about whether they would have the fortitude to raise interest rates to a level that might put the economy into a recession. I think that's a really interesting question. There may come a point here where Powell has to decide between saying, look, we're going to get back to our inflation target of 2%, but it's just going to take a few more years. So we're going to have to deal with a longer period of higher inflation versus saying that is not acceptable. And if it takes a recession to deal with this, then you need to have price stability to have a working economy. On the balance sheet, the balance sheet is just not that well understood. And when people ask about it, for those who don't follow every, whip and warp of Fed terminology, this is the Fed's $9 trillion portfolio of mostly bonds that they have purchased to provide extra stimulus. They shrunk the balance sheet in 2017 to 2019. They only ran it down by about $800 billion to about $3.7 trillion. So it's now more than double that. And there's a lot of money sloshing around in the market right now. There's a facility the Fed has where financial institutions can actually park cash because there's just so much of it right now. So, I could be wrong about this, but the ability to shrink the balance sheet when there's, when the banking system is this much awash in reserves, that doesn't seem like the challenge. The challenge really is more, if we're looking at 4% inflation or higher at the end of this year, then Jay Powell is going to have some sleepless nights.
And someone asked, Nick, what's your take on the argument that the Fed's actions, both during the pandemic and during the great financial crisis of 2008-9, worsened inequality in the economy?
Yeah, that's, it's not disputed that if you look at over the last 40 years, asset owners in this economy have done very well. And that has coincided, and the Fed has probably contributed to that, right? Because interest rates have fallen. But I think there's a danger of getting a little bit carried away with that argument, because you have to do sort of this, the counterfactual game, which is, all right, well, what if the Fed had raised interest rates in 2010 or 2011? Would the economy have been better off, even for, so maybe people at the top wouldn't have made as much money as they did on their stock portfolios or their home prices once we hit the bottom in the housing market. But, would there have been fewer jobs? Would there have been less employment? And, you don't have to actually do the counterfactual test. The European Central Bank raised interest rates in 2011. And what did that get them? It got them a recession and having to do even more novel monetary policy, negative interest rates, more QE, purchases of corporate debt. So, there's a danger here. Yes, the Fed's policies contribute to higher asset prices, and so the haves have more than the have-nots. But I'm not sure that if we ran it in the other direction, that people would be happier, right? We narrowed inequality in the 1930s, and I'm not sure that anybody would want to do something like that. I mean, I'll turn the tables here. I think there's a lot of focus on what the Fed could do, but there's sometimes not as much attention on tax policy or regulatory policy. And you just had a book come out a few months ago about a piece of the tax proposal or the tax legislation from 2017. Spend a minute here. I mean, what was it that you found when you wrote about the Opportunity Zones tax break?
Right. So I think your point is exactly right, that it is true that when the Fed lowers interest rates and buys a lot of bonds, it drives up asset prices. And that's good for people who own assets, people who own houses, as well as people who own stocks. But if the unemployment rate were higher and the stock market were lower, I don't think we'd be a lot happier. But I think you're right. If we really want to worry about inequality, the Fed is not the place to go. Congress is the place to go. And the book I did, Only the Rich Can Play, talks about the story of Opportunity Zones, which is a tax break that only rich people can take advantage of. It's sold as a way to encourage rich people to put money into poor neighborhoods. But in fact, given the neighborhoods that were chosen and the rules of the game, I don't think it's doing that much. So it's really interesting to me that despite all the anger about inequality in the US, almost all the tax increases on the rich that Joe Biden campaigned on have failed in Congress. They can't get through. So, I know sometimes we must sound like shills for the Federal Reserve because it's blamed for creating inequality. But I think your point is exactly right. If as a society we want to do something about inequality, the door to knock on is at Capitol Hill, not at Constitution and C Streets. So I agree with that. I think we've pretty much run out of time. I think I'm supposed to turn it over to Weir, who is going to make another plug for buying the book. I hope you all will. I think the Fed is poorly understood by most people. And so anything that journalists can do to shed light on what is the single most powerful economic institution in the world is a worthy cause. So Weir or Faith, are you going to give us the benediction?
Yes, it's me. I just wanted to say thank you so much, David, for facilitating this conversation and being back here at Town Hall. And Nick, thank you so much for sharing your story and educating our audience tonight on this very relevant, ever-ending topic. Thank you so much.
Thanks for having us.
Yes, and to my audience at home, please remember to pick up a copy through our friends at Third Place Books, and that link can be found in the chat. Everyone, have a great night.